Improving your credit score quickly might sound daunting, but it can be done by focusing on the right factors. Visualize a pie chart of FICO credit score factors on screen. Payment history, 35%, credit utilization 30%, length of history 15%, new credit 10%, credit mix 10%. Credit scores are mainly determined by payment history and debt usage, followed by how long you've had credit, how much new credit you've taken on, and your mix of credit types. In this video, we'll cover 7 proven credit repair tips to help boost your credit score and raise it as quickly as possible. These tips include making on-time payments, lowering your credit utilization, fixing errors on your credit report, and more. We'll explain each tip in an informative, step-by-step way, with real-life examples and visuals to guide you. So whether you're a credit newbie or a seasoned borrower, you'll know exactly how to improve your credit score fast. On that note, remember there's no instant miracle fix, but by the end of this video, you'll have a clear action plan to raise your credit score quickly and sustainably. First things first, pull your credit reports and look for errors. You can request your reports for free, for example, via annualcreditreport.com, and comb through each line. Mistakes happen. Maybe a payment is wrongly marked late, an account that isn't yours shows up, or an old derogatory mark is still listed past its expiration date. Any such error could be unfairly dragging down your score. If you spot something inaccurate, file a dispute with the credit bureau to get it corrected or removed. Correcting a single significant error, such as a falsely reported late payment, can boost your score quickly once fixed. You're entitled to free credit reports from all 3 bureaus, so use that to your advantage and double-check everything. Disputing errors does take a bit of effort, but it's worth it. By law, bureaus generally must investigate within 30 to 45 days. That means you could see an unjust negative item wiped out and your score improve within a month or two. A fast win for your credit health. Real-life example: one viewer found that a paid-off loan was still reported as unpaid. After disputing this error and getting it removed, their credit score jumped up noticeably in the next reporting cycle. Payment history is the #1 factor in your credit score. It makes up about 35% of your score on average. That means the most important thing you can do is pay every bill on time, every time. Even a single missed payment can cause a big drop in your score. In fact, if you've otherwise been a good payer, one 30-day late payment can knock 50 to 100 points off your score. Ouch! Late payments also stay on your credit report for up to 7 years, so the damage lingers. Visual aid: show a calendar with payment due dates circled in green, and one date marked in red, missed, with a plummeting score arrow to illustrate the impact. To avoid this, leverage technology and habits. Set up automatic payments or calendar reminders for all your credit cards, loans, and utilities. Autopay is a lifesaver. It can ensure at least the minimum gets paid by the due date so you never accidentally skip a bill. If you're wary of autopay, at least schedule reminder alerts a few days before due dates. Also, consider paying bills early or splitting into bi-weekly payments, which not only guarantees timely payment, but can also keep balances lower, a bonus for your utilization, as we'll discuss soon. If you do slip up and miss a payment by over 30 days, act quickly. Pay the overdue amount immediately, and then call the creditor. Sometimes, if it's a one-time mistake and you've been reliable, you can politely ask if they'll refrain from reporting the late payment to the bureaus. You might be surprised. Creditors sometimes grant a goodwill adjustment. Bottom line, protect your payment history fiercely. It's the foundation of your credit score, and a perfect on-time payment record will steadily boost your credit score over time. And remember, consistent timely payments can even show results in as little as a month or two, since lenders report your payment behavior every 30 days. After payment history, the next biggest factor in your score is how much debt you're carrying versus your credit limits, known as your credit utilization ratio. This accounts for approximately 30% of your score. The fastest way to improve your credit score is often to reduce that utilization by paying down your credit card balances. High revolving balances make you look risky to lenders, while low utilization shows you're managing credit wisely. Aim to use under 30% of your credit limit on each card and overall, but the lower, the better. For top credit scores, experts often see utilization in the single digits. For example, if you have a card with a $10,000 limit, try not to carry more than about $3,000, 30%, on it. And if you can keep it at $1,000, 10%, or less, that's even better. As you pay down those balances, your utilization falls and your credit score can rise quickly in response. In fact, this can happen as soon as the next reporting cycle, typically within 30 days, once your card issuer updates the lower balance to the bureaus. To accelerate this process, you could make an extra mid-cycle payment so that your statement closes with a smaller balance, or pay off big chunks using any windfalls, tax refunds, bonuses, etc. What if you're already paying as much as you can? Another tactic is to increase your available credit while not increasing your spending. For instance, you can ask your credit card issuer for a higher credit limit. If you have a solid history with them or your income has gone up, they might grant an increase. And if they do, it immediately lowers your utilization ratio because your balance is now a smaller fraction of a larger limit. As NerdWallet notes, when your credit limit increases while your balance stays the same, your overall utilization goes down, which can improve your credit. Just be careful. Request credit line increases sparingly, preferably without a hard inquiry if possible, and don't use the newly available credit to rack up more debt. The goal is to widen the gap between your credit limits and your balances, not to fill it with new spending. By attacking your debts and/or boosting your limits, you'll see a lower utilization percentage and likely a fast credit score boost once these changes hit your reports. Real-life example. One user shared that by aggressively paying down their credit cards from nearly maxed out to about 20% utilization, their score jumped within a single billing cycle, enough to move them from fair to good credit, which saved them hundreds on a new car loan's interest rate. If you have a thin credit file or less than stellar credit, piggybacking on someone else's excellent credit can give you a quick boost. This strategy involves becoming an authorized user on another person's credit card account. Here's how it works. Find someone you trust and who trusts you, often a parent, other relative, or close mentor, who has a credit card with a long history, a high credit limit, and a record of on-time payments. Ask if they would be willing to add you as an authorized user on that card. You don't even need to use the card or know the account details for this to help you. Once you're added, that card's positive history and credit line can start appearing on your credit report as if you'd had that account all along. This can improve your credit mix and length of history overnight and significantly boost a weak score. In fact, if someone has a very limited credit history, this tactic can sometimes raise their credit score by a large amount. Some reports say even on the order of 50 to 100 points. For example, one Reddit user saw their score climb from 496 to 660 in just 3 months after being added as an authorized user on a responsible family member's card. That's a dramatic jump. Important cautions. Make sure the card reports to all 3 major credit bureaus. Most do, but it's good to confirm, so you get the full benefit. And choose your account holder wisely. Their habits will directly affect you. If they miss a payment or max out the card, that negative activity will hit your credit too. So this is something to do only with someone who is extremely reliable financially. Also, discuss beforehand whether you'll actually use the card or not. In many cases, the primary cardholder can add you and not even give you a physical card, which might make you both more comfortable. The goal here is simply to piggyback on their great credit behavior. Done correctly, being an authorized user is a fast, legitimate way to inherit a strong credit line on your report. It's like getting a head start based on their years of good credit. Just remember to express your gratitude. they're helping you out in a big way, and continue to build your own good credit habits in the meantime. Credit scoring models reward you for having a mix of different credit types. This factor, known as your credit mix, makes up about 10% of your FICO score. In plain language, lenders like to see that you can handle both revolving credit, like credit cards, and installment loans, like car loans, mortgages, or student loans. If you've only ever had credit cards, or only loans, adding the other type can broaden your credit profile and potentially give your score a lift. Now, this tip isn't about immediately boosting your score within days, but it's a proven strategy to strengthen your credit score relatively quickly over a few months. For example, if you have no credit cards and only installment loans, consider getting a credit card, perhaps a starter card or a secured card if needed, to add revolving credit to your mix. Conversely, if you have only credit cards and no loans, you might consider a small personal loan or credit builder loan. Even a modest loan that you pay back on time can add to your credit mix and show creditors you can handle different types of debt. One caveat: don't open too many accounts at once in the name of credit mix. A new account typically causes a small, temporary score dip due to the hard inquiry and reduced average account age, so you want to be strategic. Choose one account that really adds value to your profile. For instance, a credit builder loan from a bank or credit union can be a low-risk way to get an installment account on your report. You borrow a small amount that's held in an account, you make payments on it, and at the end you get the money, or a CD, while all payments have been reported. Or, if you need a car and can afford it, an auto loan, at a reasonable rate, will not only get you the car, but also count as an installment trade line on your credit report. New credit cards can help your mix and raise your total available credit, which can further improve utilization if used wisely. For example, say you only have one credit card. Adding a second credit card could improve your mix and also give you more credit limit headroom. Just be careful not to double your debt along with it. In short, responsibly adding a new type of credit can strengthen the credit mix portion of your score. Lenders see a variety of accounts and think, all right, this person can juggle different kinds of credit responsibly. Over time, that translates into a higher score. Just remember, only take on credit you actually need and can manage. Diversification is helpful, but unnecessary debt is not. So plan any new accounts carefully, and as always, pay them on time. Pro tip: if you do decide to open a new account for Credit Mix, try to space it out. Don't also apply for 3 other cards in the same month. We'll talk more about limiting inquiries next. While building credit, it's important to be mindful about new credit. Every time you apply for a loan, credit card, or any credit line, the lender usually does a hard inquiry on your credit report. Hard inquiries can cause a temporary dip in your score, typically only a few points, often 5 points or less per inquiry, but they add up if you do many in a short time. Moreover, opening several new accounts around the same time can hurt your average account age and signal potential risk to lenders. If you're aiming to raise your credit score quickly, avoid unnecessary credit applications for a while. Each new credit card or loan you chase might knock your score down slightly in the short term, essentially counteracting the improvements you're trying to make. Instead, be strategic. Apply for new credit only when really needed. And when you do, research and choose carefully so you have a good chance of approval with one try. Don't scatter applications everywhere. If you're shopping for a single big loan like a mortgage or auto loan, try to do your rate shopping within a focused time frame, typically 14 to 45 days depending on the scoring model, so that multiple inquiries count as one for scoring purposes. Another aspect: as we discussed in Tip 5, adding a new account can help in some ways, but you want to space out applications. A good rule of thumb is to wait at least 3 to 6 months, or more, between new credit applications when possible. This way, you give your score time to rebound from the inquiry and show some positive payment history on any new account before adding another. By limiting new credit, you'll preserve your current score and let your existing positive behavior paying on time, paying down balances, shine through without offset. Lenders and scoring models take comfort in stability. A flurry of new credit requests can be a red flag, so we want to avoid that. Real-life example. A young professional excited by credit card rewards applied for 5 credit cards in 2 months. His score fell about 30 points from the combined impact of multiple inquiries and new accounts. He learned to pause and space out those applications. A year later, with no further inquiries and good payment history on the cards he got, his score not only recovered but climbed higher. The lesson: patience and moderation with new credit pay off. Your credit history length, how long you've had credit, is another important factor, around 15% of your score. Generally, the longer your credit accounts have been open and in good standing, the better. So one often overlooked tip to boost your credit score, or rather, avoid unintentionally lowering it, is don't hastily close your old credit accounts, especially your oldest credit card. When you close an account, 2 things can happen. 1. You eventually lose the credit history from that account. It will fall off your report in about 10 years if it was in good standing, which can shorten your apparent credit history. And 2. You reduce your total available credit, which can increase your utilization percentage if you carry balances. Both effects can hurt your score. Credit scoring algorithms favor older accounts because they demonstrate stability. If you've had a credit card for 10 years, that's 10 years of history contributing to your score. A very positive thing if you've managed it well. Suddenly closing that card would erase a big chunk of your track record and could cripple your average account age metric. As one source puts it, closing old credit cards or loans prematurely erases their positive history and hurts your average age of accounts. In turn, a shorter average credit age can signal less experience managing credit, and your score might drop accordingly. So, as a rule, keep your oldest cards open. Even if you don't use an old card much, it can be helpful to your score just by sitting there with a long history and available credit. Now, there are sensible reasons you might consider closing an account. For instance, if it has a high annual fee and you're not using it. In such cases, see if you can downgrade the card to a no-fee version or transfer the credit line to another card with the same issuer, rather than closing it outright. Often, issuers will let you product change to a card with no fee, which means you keep the account open, retaining the history, but you stop paying a fee. Another tactic is to simply use old cards occasionally, say once every few months for a small purchase, to keep them active. Card issuers might close an account for inactivity after a long period, so put a recurring subscription or a cup of coffee on the card and pay it off. This keeps the account alive and you in control. Also, if you're worried about having too many cards, remember you can always cut up the physical card or lock it so you're not tempted to use it, but still keep the account open. Patience is key here. As your accounts age, your score gradually benefits. Closing accounts needlessly is like cutting off branches of your credit tree. Better to let them grow. Over time, a longer average credit history will raise your score, so cherish those old accounts that have no negatives. They are an asset to your credit profile. Real-life example. Emily had a credit card from 10 years ago with a $0 annual fee that she rarely used. She thought about closing it since she favored newer cards with rewards, but after learning this tip, she kept it open. When she pulled her credit report later, she saw that card was her oldest account and significantly raised her average account age, contributing to her FICO score being over 800. Had she closed it, her average age of accounts would have been much lower. The take-home point: sometimes doing nothing, just keeping an account open, is the smart move for your credit. Congratulations for sticking with us through these 7 tips. By now, you should have a clear roadmap to improve your credit score fast. Let's quickly recap the strategies. Check your credit reports for errors and fix them. Pay every bill on time. Knock down your credit card balances and/or raise your limits. To keep utilization low, consider an authorized user boost if it makes sense. Diversify your credit mix with a new account carefully if your profile is thin. Go easy on new credit applications, and keep your good old accounts open. Each of these tips targets a specific aspect of how your credit score is calculated, and together they cover a big portion of the scoring formula, from the 35% weight of payment history to the smaller but still important factors like credit mix and new inquiries. Implementing these credit repair tips in parallel can lead to a noticeable score increase in a matter of months or even weeks, especially if you were overlooking any of them before. Remember, as Experian emphasizes, paying bills on time and using less of your available credit can raise your credit in as little as 30 days. Realistically, significant improvements might take a few months of consistent effort, but every positive step counts. A higher credit score can unlock better interest rates on loans, higher credit limits, and more financial opportunities. It's worth the effort. Just be wary of anyone who promises a quick fix for a fee. You now know the legitimate steps to boost your score, and none of them require paying a credit repair company to do magic. In fact, no company can remove accurate negative info from your report or instantly add 100 points to your score. If something sounds too good to be true, it probably is. The power to improve your credit is truly in your hands using the tips we've discussed. Going forward, monitor your progress. Use free tools. Many banks and websites offer free credit score tracking to watch your score climb as you implement these changes. Seeing those numbers go up can be really motivating, and even after you get the boost you need fast. Remember that building and maintaining excellent credit is a lifelong game of good habits. The tips you learned here, like paying on time and keeping balances low, will not only raise your credit score quickly, but also help you keep it high for years to come. Thank you for watching. If you found these tips helpful, feel free to like the video and subscribe for more insights on personal finance. Now go out there and start implementing these proven strategies to boost your credit score. You've got this. A better credit score, and the financial freedom that comes with it, is well within your reach with a bit of focus and effort. Here's to your credit success.